Welcome to the XFO Intelligence Podcast Complex-Q Series. Today, we're diving into the Evergreen paradox, architecting liquidity transformation without sacrificing the illiquidity premium. If you haven't already, don't forget to like, share, subscribe, and send us your feedback at xfointelligence@gmail.com. Evergreen funds have unlocked private market returns for a broader audience, offering liquidity windows while investing in illiquid assets. But there's a tension. Investors want predictable access to capital, while the underlying assets require years to mature. In market shocks, this mismatch can cause redemption spirals, leading to fire sales and value erosion. Preventing run risk isn't about hoarding cash or restricting access. It means pricing liquidity transformation, managing it dynamically, and governing it transparently. Let's break down the frameworks. First, Evergreen liquidity transformation. Liquidity can't be invented. It must be matched, priced, or deferred. Run risk comes from three frictions: unpriced redemption optionality, valuation lag, and behavioral amplification. The solution? Internalize liquidity costs and neutralize first-mover advantage. Second, next-generation stress testing. It must be forward-looking, behaviorally calibrated, and regime-aware. Model diverse investors. Map asset liquidity horizons, run correlated scenarios, and track key metrics. Stress tests must directly inform buffers, gating triggers, and facility covenants. Third, dynamic tiered liquidity buffers. Static cash targets don't work. Evergreen funds need layered buffers. Tier 1 for high-quality liquidity, Tier 2 for credit facilities, and Tier 3 for contingent market-based options. Buffers should rebalance continuously based on stress test insights. Fourth, redemption mechanics. Gating, swing pricing, and notice extensions are stabilizers. Pre-committed triggers and dynamic swing factors align redemption pacing with asset realization. Side pockets isolate illiquids, and transparent investor communication reduces panic. Fifth, evolving regulatory capital. We need dynamic liquidity monitoring instead of static capital floors. Proportionate capital treatment should recognize gating, swing pricing, and stress test disclosures. Standardized reporting and harmonized regulations can prevent arbitrage and support global consistency. Finally, aligning fees, advisors, valuations, and LP expectations to the reality of liquidity transformation is critical. Funds that price liquidity as a market condition, not a feature, will retain long-term capital and preserve the illiquidity premium. Thank you for joining us. Remember to like, share, and subscribe. If you have feedback, email us at xfointelligence@gmail.com. Until next time, this is the Complex-Q Series.